It's Brian Preston, the money guy.
Yeah, I mean, let's kind of go through some of these because I worry about the weight of the obligations, the debt chains, if you wanted to say, because I think we are one of the unique financial channels where we don't badmouth debt all the time.
Sure.
But we're definitely chainsaw scared of debt. You know, you've heard us make that analogy. We've even told you, please don't sell pictures like some of you have done, where we think that debt is a tool, but it's one, just like your chainsaw is a tool. It's a dangerous tool because if you make one or two mistakes with it, it could be pretty catastrophic. And I think that now that interest rates have gone up, debt, the burden or what it can do to hurt you is becoming even more troubling. And look at credit cards. Credit cards, over the last 10 years, the interest rate charged by credit card companies already 12.98 or close to 13%. That, to me, that feels like that is punitive.
Sure.
Because if I'm telling you we can build $1 million off of 8 to 10%, and then you find out the credit cards are making 12 to 13% in this low interest rate environment.
There's a reason they have the big buildings.
Like, whoa, I see how these guys are the house. They're the ones that are doing so well. Well, fast forward now, credit card debt is now 18.44%. Guys, how do you recover from that if you're carrying any type of credit card debt? Be very aware that debt being more expensive is so punitive, you are turning compounding interest upside down on you. Auto loans.
Yeah, it's not just credit cards. When you look at cars, and you have to remember, the last 10 years has been unique. And I do not worry, that's the wrong word to use. But I do think it's important for folks, again, that are just getting out into the working world, that are just starting their careers, that have maybe only been doing this for the last decade or so, to recognize the last 10 years have been unique. Not a different paradigm, not a different universe, but they've been unique. We have been in a low interest rate environment. So when you look at like auto loans, the average auto loan over the last 10 years has been about 4.6%, but it was not uncommon to go to a car dealership and see someone offering 0.9% financing, 1.9% financing, 2.5% financing. As rates rise, those types of offers may be fewer and farther between. And we're already starting to see that increase. Over the last 10 years, the average auto loan is about 4.6%. As of right now today, the current average auto loan that's being offered is 5.7%. So the average has gone up by a full percentage point. If rates continue to rise, I think we're going to continue to see that increase.
Well, I think it's even worse in the fact that whenever we pull up any historic data, there's a lag. Without a doubt, over the probably next 2 to 3 months, you're going to see auto loans, I think, be in the 6 to 7s. We might even reach the 8%, depending on what the Federal Reserve does with rates. And that translates, think about student loans. Now, student loans, we're in this weird period where because of the pandemic, the federal government has been basically saying, hey, no interest is accruing on all the government-owned federal debt out there for student loans. And then we've even got this whole debate over the $10,000 that could be forgiven. But I want to make sure that anybody out there who's in college age or you have children who are quickly approaching college age, you've got to be very aware that I think we're headed towards a period where student loan debt is going to be in the 6 to 7, even that could be in the 8% range. Guys, measure twice, cut once on this student loan debt. I mean, when you hear somebody talk about debts that could potentially be good for you, I always talk about mortgages, you talk about student loans, but I got to tell you, I'm so worried that we've turned the institution of education into a negative, that you've got to be careful making sure that this debt is something you can process afterwards. That's why we always, just like auto loans, we have 23-8, meaning 20% down. Don't finance to do that amortization over 3 years, and then make sure that the monthly payments don't exceed 8% if you annualized it, but you're basically taking 8% times your gross income, dividing it by 12, make sure your payments don't exceed that. Student loans, I want you to put some guardrails up that your first year of income coming out of college, you don't let that student loan debt exceed that, because guys, if you get too much of this debt, it really is going to become a weighted chain. In the past, it might have looked like it was just a gold chain around your neck. You put your favorite charm on there. But soon, it's going to look like these are the type of chains that you struggle to pull them out of the back of the Jeep because you need to winch yourself out. It's going to weigh you down. I'm just telling you, be very careful. All debt is more expensive. That's why we put it into the bad column. It could be very dangerous to your financial future.